next is modern portfolio theory. Okay. Harry Markowitz. In the 50s, won basically the Nobel Prize. He invented modern portfolio theory, or what is called MPT. MPT basically states you have expected return on the y-axis and you have portfolio standard deviation on the x-axis. Up from the origin is what is called the capital allocation line. And again, you know how to calculate the portfolio standard deviation. And from the capital allocation line, there's basically an umbrella, which is called the efficient frontier. You can build portfolios any point along the efficient frontier and inside the umbrella using assets in the capital markets that are available to you. So you can just pull the assets together and build a portfolio. Those are the ones that are available in the market. So you can build a 100% stock portfolio. Obviously, it's going to give you high risk, but you're also going to be compensated, with high return. You can also build a 100% bond portfolio. Yes, you're going to get low risk, but you're also going to get low return. Yes, sir.
Can you restate what the axis is represent?
Yes.
The axes
Yes, sir. These are the expected return on the portfolio, and this is the standard deviation of the risk of the portfolio. So if you want to a higher rate of return and you're willing to take on more risk, you would sell off your bonds and increase your allocation to stock. If you want to reduce the risk in your portfolio and you're willing to take a lower rate of return, you can sell off your stock and increase your bond allocation. Once the efficient frontier and the capital allocation line are tangent to each other, that is called the market basket. And historically, the market basket, because most investors, 80, 90 years ago, 70 years ago, there was only stocks and bonds in the marketplace that you could build a portfolio. And if you looked at the value of stocks and the value of bonds and you added them together and then divided them back to get the percentage, the market basket was 70% stock, 30% stock and 70% bonds. So that would have been your market allocation. And investors, particularly institutional investors, want utility within their investments. And they would love to be up here where they can get high rates of return and low risk, but there's nothing in the market. So what they have to do is they have to lower their utility to get to the point where they can get to an investable basket. So they have to reduce their utility. They're willing to take on risk, but they want to be compensated for it. And at this point, where the market basket is, this is your highest expected return on the portfolio for the given level of risk on the portfolio. So that's actually the point where your expected return divided by the standard deviation of the portfolio, the inverse of the coefficient of variation, is going to give you the highest risk-adjusted rate of return. Now, all institutional and risk-averse investors want 8 to 10% rate of return on their portfolios, because under the rule of 72, their money will double in less than 10 years if they get that. So this is pretty much what everybody wants. the objective is not only expected return of this, but the other is to reduce the portfolio standard deviation through diversification. Putting assets together in the portfolio whose returns have low, no, or negative correlation with each other.
I assume further to the right is higher standard deviation.
This is going to be higher standard deviation risk. This is going to be lower standard deviation risk and higher return.
Okay.
Okay? So, if you add assets to the portfolio with no, low, or negative correlation in the returns, this is the key, because what it will do is it will bow out the efficient frontier. So it bows out the efficient frontier. Now, what's going to happen is you're going to get lower expected return in the portfolio, but you're going to get significantly lower portfolio standard deviation. So if I can significantly lower this, I can significantly raise or increase the risk-adjusted rate of return, which means that me as a risk-averse investor, institutional investor, is better off. That's the objective. So how do you do it in a multi-asset portfolio? You bring in alternatives. How are we doing on time?
15.
You invest in alternative investments, or what are called alts. The book doesn't really talk about these, and neither does really any other literature in the curriculum. Talk about alternatives, although alternatives are a whole new asset class that has emerged over the last 10 to 15 years, where the returns have low, no, or negative correlation in stocks and bonds, so it bows out the efficient frontier and increases the risk-adjusted rate of return for institutional investors. So there's something missing in the book. Okay? And it's not even in the investments book. Okay? They're missing that too. So these alternative investments would be cash value life insurance, Northwestern, New York Life, Ohio, Guardian, private equity, commercial real estate. We don't have a real estate class in this program. So we're missing a huge asset class outside the curriculum. And then lastly, alternative renewable energy, also called infrastructure. Wind, geothermal, biogas, community choice aggregation utilities, these are alternatives. Now, cash value life insurance, Ibbotson and Associates, did research 15 years ago, ran the portfolio analytics, and came up with a 10% allocation to cash value life insurance. Everybody should have 10% of their net wealth and their cash flows going into cash value life insurance. And the allocation was institutionalized through bank-owned life insurance, where banks basically put life insurance policies on their senior executives, plow money into them, build up this cash value, and that cash value is considered tier 1 liquid capital for the bank. So it's been instituted, used by investment banks and banks. Already, everybody thinks of it as just life insurance, but it's really a tool for liquidity for banking institutions. And I didn't even know about it until like 7, 8 years ago. I had no freaking idea. And Ibbotson also did the research in the 80s, ran the analytics on private private equity commercial real estate and came up with the 10% allocation to private equity real estate. And again, this is not public equity, these aren't REITs or traded on this exchange, this is private equity, this is private. And lastly, alternative renewable energy, Deutsche Bank REEF, probably must have been almost 9 years ago, did the research, ran the analytics, and came up with a 10% allocation to alternative renewable energy projects. And this market's going to explode within the next 20, 30 years.
How risky are those alternative investment options?
These have sponsors, they're opaque, you trade in the private market, once you're in, you're locked in, so there's high illiquidity risk premiums. Okay, and you gotta underwrite the projects here, you gotta underwrite the project assets here, you have to look at the sponsors, you have to really do your due diligence. But you have to be accredited to buy this stuff, which means you have to have at least a net worth of $1 million, and you gotta be making at least $250 grand a year in adjustable gross income. Okay, so it's hard to get to them if you're not qualified.
Okay. Do they fall on that umbrella scale that you have over there, or are they kind
What
of?
they do is what I came up with based on the research was a model. I think this might answer your question. Target portfolio allocation. Really specific towards the institutional and risk-averse investor, which almost everybody is. 40% bonds, 30% stock, 10% cash value life insurance, 10% private equity real estate, and 10% alternative energy. If you add these three into your stock bond portfolio, it goes out the efficient frontier, reduces the expected return on the portfolio, but significantly reduces the portfolio standard deviation, significantly more than the reduction in the return, thereby is increasing the risk-adjusted rate of return on the portfolio, which is exactly what institutional and risk-averse investors want. Now, you can go back into the portfolio and you can put mortgage finance on the real estate and on the energy. You can buy your stock on margin and lever up the portfolio. Yeah, you're going to get a higher rate of return, but you're going to take on more risk through the process of leverage. And you can also move down the efficient frontier, or the capital allocation line, through the process of lending, which is what banks do, which will reduce the rate of return, but significantly reduce the risk within the portfolio. So there's even some strategies, you can even lever to get more return. But the key to understand is these are new asset classes, or alternative asset classes. And when you're studying this, they usually never look at that stuff. They just use stocks and bonds and leverage and stuff. But if you add in these alternatives, which I believe is the future of where investment is going, because bond yields are so low and the stock market's so risky, people are looking for alternative places to put money. If you're interested in energy, renewable, massive capital flows are going to go into there. There's tax incentives and other stuff. And there's still a ton of money going into real estate. And there's a ton of money going into life insurance. I think that's it. Any questions on modern portfolio theory and efficient frontier, capital allocation line, low, no negative correlation in the returns to stocks and bonds, blows out the efficient frontier, reduces the return, and significantly reduces the risk within the portfolio, increasing the risk-adjusted rate of return, which is actually what these guys want.
So back to the insurance one. So the banks have their executives and
Yeah,
they
they-
have them written out as just the assets, I
Yeah,
guess, and or something?
the insurance policies are paid by the banks on the executives, and the banks are the beneficiaries of the life insurance policies. And as they pay the premiums in these life insurance policies, it builds cash value.
Mhm.
And these cash values, it's just like having cash in the bank. It's highly liquid, and the regulators have categorized them as tier one, which is the most liquid form of capital for the bank.
Huh,
And I had no idea.
just fascinating.
It is fascinating. It is. And I had no idea, like 9 years ago, where that was going. Any other questions you want to stop at? So if you have any questions in these areas, I'm an expert in